This week, we are going to talk about directional trading. Last week, we talked about hedging because the market was just so concentrated on three securities. And even though that's still prevalent and absolutely timely, this week we're shifting from protection into directional trading. So options, the beauty of them, we can use them for hedging, we can utilize them for income, we can use them for the long term, we can use them for the short term, and we can also utilize them to speculate. Today we are going to talk about the speculation end, and I am going to take you through the journey of how that really graduates from an options trader. We'll focus on long calls mainly, or the call side rather, and then shift slightly over into the puts. But meaning we'll do a long call, graduate into a debit spread, and then graduate into a broken wing butterfly. So all being directional, end up in the, well, we can call that a four-legged trade space at the end. Nonetheless, let's dive in. All right. And quick disclaimer, as per usual, I'm going to have some real trades up today. I will have some past ones I actually pulled from the show that Tony and I do weekly with Fidelity in the Money, where we give trade ideas. There was a couple of broken wing butterfly spreads on there. So I pulled three of those so we can revisit those, Apple, Nvidia, and CrowdStrike. So it will be very interesting. But those are older trades. I haven't done my due diligence for redoing those. So just want you to know that's informational and educational purposes only. It's not intended to be a solicit to buy or sell a security. This is an educational webinar that you are attending today. Nonetheless, let's dive in. Okay. Now, you guys know that I love talking about the Greeks, and we'll bring this in because the beauty of the Greeks is we are going to focus on maximizing the positive and mitigating the negative. So if you've ever attended my Greek sessions, you should be taken away with this slide. This is where we end it, where we focus on the positive effects and the negative effects that various factors have on options. The Greeks tell us the impact of internal and external factors on an options premium. If we understand how price can change, then we can understand how to align our sentiment and strategy that's inclusive of entry and exit points. So I'll run you through this really quickly. This is not a Greeks presentation, and I'll just give you the takeaways that you need to understand the directional trading, or what we'll focus on rather today. So if you've never seen this before, I like to call this OptionsPlay's most stolen slide, which is absolutely fine. If you do use it and tweet it, just give us a little bit of credit. Spent way too much time on this graphic, but it drives the point home. Nonetheless, on the left-hand side, you're going to find the calls. On the right-hand side, you will find the puts. It starts with long calls on the upper left-hand side, and then short puts are going to be on the upper right-hand side. And that's because bullish strategies are going to be found on the top and bearish strategies are found at the bottom. You can utilize this, and if you understand a long call inside and out, then you can utilize this chart really as a mirror to figure everything else out. So the important takeaways from this: when I am purchasing options, this is where directional trading comes in, because you are expecting a sharp directional move in your desired direction. You have a directional bias, whether it's up or down. It's purchased for a premium. You own the execution rights. If I own execution rights, I'm in the driver's seat. I want that option contract to have as much value as possible, but things can inflate and deflate that premium. And that's why we can layer options together, which we're definitely going to focus on today. Because I purchased those options, I also purchased time, and time is a decaying asset. The option is generally worth only its executable value on the day of expiration. Therefore, that is a decaying asset and something that I have to overcome. I paid a premium, I paid some time value, and that is why we're expecting a sharp directional move. There's a reason why we utilize the word sharp. It's because we need it to overcome the amount that we paid that premium for. So that is the long side. Short calls and short puts, they're the obligation side of the contract. We're required to fulfill the other terms of the contract on an individual basis. The intent of those contracts, they realize their maximum profit potential when they expire worthless. We don't want them to have any value. They are neutral with a slight directional bias, meaning we don't need a large move in either direction for them to be profitable, depending on where you put your strategy. Normally they're around at the money where we select those. You just need the underlying security to stay exactly where it is or move up or down slightly, depending on your strike price. And also, since we sold it for an upfront credit, that means the time value, the decaying component, actually works in our favor because it's decaying and we can buy it back potentially at a lower price. So all of that really is a lot of what's happening with the Greeks, if you understand pricing and those mechanics, so on and so forth. Really quick rundown of the Greeks. Delta is going to tell you directional bias. We net everything together. That's positive delta, bullish, negative delta, bearish. Simple. Can also be neutral, and we can neutralize that. Theta, positive value if time decay works in our favor, negative value if it does not work in our favor. So you can see that here. Gamma means we are profiting from a sharp directional move. That is good for long options. That is risky for short options. So long options have a positive gamma regardless if it's a call or put. Short options have a negative regardless if it's a call or put. And Vega, that is our exposure to implied volatility. So if we expect an increase in implied volatility, that's going to inflate an options premium that benefits long options. If we expect a decrease in options volatility, that is going to benefit short options. And that helps us decide if we're going to go long or short, if we're going to speculate, or if we're expecting a sharp directional move. You can really see, if you understand the Greeks, how it helps you amplify or really get into some good options trading strategies because you understand it more. Nonetheless, I won't dive into too much detail of that. We have the Greek webinar there. It's also on YouTube as well if you want to refresh yourself, where we go into a lot of detail. But I will focus on some of those and bring them all together. So let's start with a long call. A long call, if we are speculating, we are bullish. We expect the underlying security to move up, and we expect a sharp directional movement where positive gamma, positive delta, important facts there. In this example, we'll start real basic and we're going to get advanced very quickly. So if I'm buying one ABC 150 30 strike or 150 strike 30 days till expiration call for $5, I'm risking $5 total. $5 is my debit, 500 total because one contract represents 100 shares, but I have unlimited reward potential. That stock can theoretically go to an infinite price. Is that logical or probable? No, it's not. It depends on the security. If I'm expecting a sharp directional move, maybe I'd be looking at something like NVIDIA, but NVIDIA might have high implied volatility because we expect a high anticipated move, which is going to inflate the options premium. So that's why we want to structure things together. But the basics of it, if I have a long call, I just expect the security to go up in value, period. Now, if I am going to mitigate the time value component that I purchased, I could sell time. And with options, there's a gimme and a gotcha, a give or a take, right? So in this case, the give is I'm going to sell an option, a call. I'm going to create an obligatory sell price because I'm going to create the obligation to sell at a higher strike. So 160. That's going to give me an upfront premium. That's my gimme. But my gotcha is I'm capping my upwards potential. So regardless of how high ABC goes, the maximum I can make in this example is 160, but I have less of a sharp directional move that's required because I've reduced the amount that I've paid for this. And this could be helpful because you're mitigating theta, where time value doesn't really become a component because you've minimized the issue, if you see what I mean. So that's where strike price selection is extremely important, but I want you to get the basics down so we can go through the directional views, but want to make sure that makes sense. With a long call, I need to overcome $5 basically is what I paid for it. With a bull call spread, the strategy driver, little trick of I learned very, very long time ago, is always the most expensive option when we're looking at multi-leg options. So here the long call is the strategy driver. The short call, since it's a further out of the money option, because the right to buy at 150 is more valuable than the right to buy at 160. Because remember, a call represents the right to buy. That 160 is going to be less in value purely because of the mechanics behind it. Therefore, the long call is the driver of this entire strategy. The short call is an extension of it. And so we only need to overcome 350 at this point rather than 5. So that's the intent of that. And we can even layer on more options and become directional. So one is expecting a very large sharp increase, if we expect less of an increase than a bull call spread or a long call vertical, would make sense from a bullish bias side. All right. And we're talking about equity options here. I see some other questions in there. All right. So now let's talk about combining them together. Like I said, we're going to get advanced really, really quickly and talk about the butterfly. This is one of my favorite directional trades, but we've got to wrap our heads around it. And there's a couple ways to explain this. And sometimes I go back and forth. And again, we're going to have some real examples because I think that's important for this one. Bull call spread, we just talked about. We still have a positive delta because we're bullish. We could have a negative or a positive theta. It really depends on strike price selection. However, we're neutralized it. And that's important to know. Gamma is still positive and Vega is still positive in this case. Now, we talked about this. We need the underlying to move more than what we paid for. And then we cap our gain potential at the higher strike. If we're looking at a bear call spread, so where the strategy driver becomes the option we sell, meaning this is the lower option. The right to buy at 160 is more favorable than the right to buy at 170. So I'm adding an extension here. So let's separate these. So if I sell this one ABC 160 with 30 days to expiration, get a premium of 150. If I'm buying something further out of the money at 170, I'm going to pay less of a premium. And the goal for this is for ABC to stay at 160 or move lower. So that's why it's the bear call spread. We're reducing our credit that we receive for the entire strategy, or for the sell leg that we sold, right? But that's the gotcha. But the give me is its risk mitigation. When you sell a call individually, you have unlimited risk potential, because you are obligated to sell the shares, in this case at 160. So if ABC was to be at 170, 180, 190, if you don't own an offsetting position like another long call or shares, then you could potentially have to buy those at the super high price and then sell it at the lower strike price. And that obligation kicks in when it's in the money, which is when the underlying security goes well above the strike price. So the intent of a bear call spread, when the strategy driver is the short option, you still maintain that neutral and slightly directional bias to the downside, but this is an extension of the short call by simply mitigating that risk potential. It also lowers your margin requirement as well, which frees up capital. So there's some reasons behind that, and I structured this in a linear order for a reason. So when we put these together, and this really depends on where the security is, and I'm assuming ABC is around 150, you create what's called the long call butterfly, and is absolutely a bullish strategy depending on where the underlying security is upon creating the strategy. This can also be a time play as well. And again, I'm going to move into a broken wing butterfly is really the end goal to what we're going to get to today. But a long call butterfly is a bull call spread combined with a bear call spread. So those are the same trades we had before and the previous screen. I'm just adding them together, literally just pushing them together. So let's say that the strategy driver here is the long call because it's going to be the most valuable. So buying at 150, and then I'm selling 2 calls. So the reason why I'm selling 2 calls is maybe there is some heightened implied volatility, or the options are a little expensive and I want to really mitigate that. So I'll sell another call, but then I'll have a naked call associated with that because I only have one long option. So the way to mitigate that risk is buying another long option, like the bear call spread, further out of the money. And so that's the intent of this. I separated it out just so you can see it together. But if you were to do this in one trade, you'd create what's called the long call butterfly. And then you've really reduced your $5 that you've paid for that long call by but literally you pay half of it, 250 total. And then your max reward is achieved still at that same price of 160. Because remember, if I have a bull call spread, maximum gain is at 160. Bear call spread, my maximum gain is at 160 or lower. So here the sweet spot is 160. So the way that I've structured this is it's my max loss, and then you get a little bit of a danger zone. So here's my long call. I would need it to go above the amount that I paid. I'll break even as long as it moves up to 50. As the security keeps rising in value up to my highest strike price, that's my sweet spot. However, if it keeps rising, then I could end up losing. So it can go too far and that's because these are equidistant, as in there is $10 between 150 and 160 and $10 between 160 and 170. A broken wing means they're not equidistant. Hence the broken wing butterfly. Everyone's so creative in options trading. So does this make sense so far before I go into some real examples of the butterfly? But it's really an extension of a long call because that's the strategy driver. Awesome. Great. Thank you for the yes and the thumbs up and that was a fun face, and the one. Yeah, I'm loving that today. All right. So let's look at some examples. If you've never attended the Fidelity and the Money show that Tony and I do, we do it every Thursday at 2 p.m. We present our market views, we talk about the market, and then we also always have a trade idea each, sometimes opposing, sometimes in harmony, but that's what makes a market. And it's a really, really great show. So what I'm pulling is some of our previous trade ideas and the outcomes that relate to the butterfly. So this was on February 1st of 2023, so a while ago, on NVIDIA. Crazy to see this is before the split, and it's at 209.43. But this was an earnings play on NVIDIA, and it was the broken wing butterfly. So you can see here, this going back to that profit and loss chart that we had before, this is equidistant, and it's very obvious because it's very symmetrical. This is a broken wing because now there isn't a loss area, and it's because it's not equidistant, meaning the structure was the trade was placed on February 1st, 2023. It was an at the money call, so purchasing the 210 expiring March 17th, 2 of the 245s, and then buying a 265. So there's 35 here, and then there's 20 here. So that's what I mean by differences of it's not equal. There's more room for upside. And then if it goes too far, that's a shorter width, smaller width, if you will. Total cost was $831, max reward about, we'll call that 2,700. Okay, so now post earnings, NVIDIA did beat, and it kept beating. It's been the year of NVIDIA, and NVIDIA made it to 238.77 post earnings. So this was an amping up into earnings. You want to be positive Vega because implied volatility is going to start increasing if you do this well before the earnings date. So I'm not talking the day before, it's a couple weeks before the earnings date that this was placed. So that's important to think about. So what happened is up 29.34 a share. We did not purchase a strike price at 209.43. It's 210. So the intrinsic value component is 28.77. I laid out the structure here, but that is the value that it went up. So this was a winning trade, could have been closed out at this point, but you also could have waited for the time value component to also kick in. It didn't go as high as 245, 265. So you have a couple of options when you have this type of trade. One, it was an earnings play. You probably received that implied volatility collapse, which would be good for the bear call spread and anything on the short side. So it would be wise to go ahead and unwind this, because with this type of strategy, Our sweet spot, again, is 245. We don't want it to go any higher. This got to around 240. I'd call that a win and then move on. However, depending on how you feel, you could roll, you could close just the bull call side spread, or you could close just the bear call side spread. You don't have to do this all at once, and you can also create it all at once as well. So I think that's important to point out with this type of trade. This was put all at once a couple of weeks before earnings and anticipated for closing out post earnings, and this was closed out post earnings. Okay. Just a different view of what that looks like and that type of structure, especially bringing on technical analysis, because I know you guys love to talk about technical analysis. The 210 long call here at the money, clear area of resistance. If that goes through, that's going to be our new support, and it certainly was. The 245 was structured right after that gap up, another area right here of resistance. So that was a clear area of, okay, this is going to stop. And then the 265 was this second area or zone of resistance. And so this is also a way to marry technical analysis and directional trading when you want to take a sharp directional move, but you really want to mitigate the cost, because everyone was anticipating a very large move in NVIDIA. That means implied volatility was inflated. The cost of that long call was exceptionally high. So utilizing those two short 245 calls really reduced the cost. So this is one example that worked out really well when NVIDIA reported. If you did not unwind that, the risk is it blows through your strike price. You still would have made money because it's a broken wing butterfly. However, you wouldn't have made as much. So the options are important because they have expiration dates. We don't want to hold them until expiration because that equates to risk. But if our investment thesis, like in this case, was an earnings play, let's go ahead and close it out because the binary event occurred. Move on to the next one. All right, now here's Apple. This one was on May 4th. Apple was around, and this again, 2023, 165.05 at the time. This was structured with a June 2nd, so about 30 days out, buying the 165. So again, at the money, selling the 180s. So creating a bull call spread, doubling up on it. So increasing our risk, and then buying something further out of the money in order to mitigate the cost altogether. And I like to look at that as 83 cents minus about 40 cents. Okay, this is all for 40 cents. Like in terms of percentages as well is a good way to wrap your mind around it. But the total cost of this from 595 to 466 percentage wise could make sense. So Apple, again, an earnings play, did beat this time, and it was 173.37. That is a gain of $8.32 per share. But again, looking at options, we didn't have a 165.05 call here. We have a 165 even call because they're not cents. So that was up $8.37 an intrinsic value from this 165 call because it was 5 cents in the money. So that's a gain of $8.37 altogether there. And remember, there's still some time value that we could sell to close this June 2nd 185 call for. But this is an example, again, where it didn't reach the strike price, but it was still a positive earnings event, in which case the choosing a capped gain potential was a good idea. Where this could really go against you, especially if it's something with a high beta like NVIDIA, is if it does blow through your strike price. So I know I'm showing you positive scenarios. I want to make sure that you understand the negative as well. Also, if it does go down, then you lose the total amount that you purchased. That's the maximum loss potential in these type of strategies. And then I put them all together with the cost. Okay, so CrowdStrike was another one. So this was placed on June 21st. CrowdStrike was at 143.85, about 144. Purchased the 140, sold 2 of the 165s, and then bought a 175 in order to offset the unlimited risk potential that we expanded on or that we created. So total cost is 774. Max reward is about 1,700, we'll call that. So again, the intent of this is to really reduce the cost of that long leg. The outcome, 14 days till expiration on February 23rd, was about 167. So in this case, it did go through our strike price, which means we didn't make as much as we could have because we capped our gain potential. So I want to make sure we go through that. So we had a up value of $23.14 per share. The intrinsic value component was $26.99 off of the 140, but we have to account for this 199 really times two from this 165 because we have to buy to close this back because we sold to open it. So that 199, it'll cost us 3 and that will offset that. So it should be about 22. So we would have made 22 on this. Okay. And then I'm going to switch it. This is the same thing, but on the long put side. But I want to pause there and make sure that that makes sense. I know most of those were earnings plays. And the reason why I've always structured those around earnings plays is because implied volatility is very inflated. If you've ever heard of volatility crush, it is very true. Implied volatility increases when there's an anticipated movement in either direction, and that anticipated movement with a date is around binary events, the most common being earnings, especially with those high volatile, high beta securities like these technology stocks that I pointed out there. So from an earnings play perspective, never do it the day before because a long option is going to benefit from an increase in implied volatility. So we expect that to be there as retail comes in and starts participating. So you can leg into it in that way. But when you are creating these type of trades, what I want you to think about structurally wise, the entire intent of this is to reduce the cost of that long call as much as possible. That is the intent of a broken wing butterfly. This is a hugely directional trade. And when you are buying a call, you have to overcome the premium that you've paid. And so creating a broken wing long call butterfly, you're utilizing the short option to cap your gain potential, but give you as much premium as possible. You're doubling up on it. So you're exposing yourself to unlimited risk potential. We don't want to do that. That also is going to take a lot of margin and require an options level 5. And you can't do that in certain type of accounts. It has high asset levels. So in order to mitigate that risk, we purchase a long call that's further out of the money to cap that risk. You just want to make sure that the cost of that long call versus that short makes sense to reduce it all the way. So hopefully that makes sense through the thought process and directional trading that we have there. Okay, so go through long puts very quickly, but before I do that, I'm actually going to pause and just look at questions. Yes, you will get the slides for this one. Mark has a great comment probably around the strangle. So that a strangle would be very different. That's where it'd be a time play, and that's where you would choose your strike prices differently. Meaning a strangle is where you've got a well, you have a short call and a short put together. So different strategy, but kind of similar. Whereas debit spreads comes in, too many names for the same operation. That's why I love options. You can call them whatever you want. They do whatever this first slide is so important to show you because if you know what each individual leg does, then everything else falls into place. Each option will do exactly this. If you purchase a call, you have the right to buy or sell. It's called a debit spread because it's going to always cost you a debit. It's called a credit spread because it's always going to bring you a credit. Because the strategy driver is a long call, cost you a debit, or it is a short call, always brings a credit. And same is true for the put side. That's why they're called that. Also called a long call vertical because you need to go up or down. There are so many names. You can call it whatever you want, but if you put it together, it's going to function exactly the same regardless of the name. But do love that comment. Ratan said, missed the In the Money show today. What was trade? I rolled a short put on Apple that was on my maximum trade potential. And so I just rolled it out to another at the money because I'm not strongly bullish right now, still cautious on the market. Those are always posted afterwards, by the way, so you'll be able to see that tomorrow. Um, If playing earnings, why not buy an option or spread a couple weeks beforehand when volatility is not yet excessive? Yeah, absolutely. That is the point here. And these examples, they were purchased a couple weeks ahead when volatility has not increased yet because you're expecting an increase in implied volatility. And you can check that through metrics with like IV rank and IV percentile to see where implied volatility is for those securities now. No, when you are purchasing options, you are always you feel like something pricing wise is off is really what's happening without getting into nitty-gritty details. Can you explain how you decide the length of the wicks, or the length of the wings, especially for the broken wing case? Angelo, thank you for asking that question. When I am trying to figure that out, so one, the mechanics of a bull call spread still apply. So I would look for, and I'll bring back the NVIDIA example. I am a technical analyst at heart, so everything always starts with technical analysis with me and the fundamentals as well. But that is where I first choose. So when I went through this, these would have been, if it's my normal charts, clear areas of support or resistance will indicate where I want to align my strike prices with, meaning resistance, I want to account for enough room for capital appreciation while also thinking about the premium that I'm receiving. So normally when you're on the options play tool and it by default gives you the bull call spread or long call vertical, that's a great starting point because it's already giving you an indication or an ideal scenario based on risk versus reward. So the same rules apply. When I have a long call, I want to make sure that I'm able to make 3 times more than I spend. So that's going to be based on where my price target is. When I have a bull call spread, long call vertical, same applies. Want to be able to make 3 times more than I spent. And that's factored in when you consider the premium that you're receiving and reducing the overall cost of the trade. The addition, so you'd have to, when you are adding for example, if I was getting $1 for this short call, but this long call cost me 80 cents, that really means I'm taking on this extra risk for 20 cents. Does that make sense? No. Does that help my risk to reward ratio? Not as much. So I would either have to widen my widths, as in my 265 would have to be higher, but then I could get myself in a loss scenario if it goes too high, too fast, which happens if you're trading something like NVIDIA or these super technology stocks. So the way that I choose them starts with the rules apply that Tony teaches and that we teach, with the making sure that you, when we're directional, make 3 times more than you spend. That is rule number 1, always steadfast and true. Same stop loss rules apply as well. Pair that with clear stopping and starting points. So your technical analysis, areas of support and resistance, that all applies as well with your investment thesis because we want to make sure that's aligned. And then it's really maximizing that risk versus reward and making sure the additional risk I'm taking on, because it's additional risk by creating a bear call spread in this case, makes sense. So like I said, if you're bringing in 20 cents for that additional risk, it doesn't make sense. So hopefully that helps. Okay. How do we join the Fidelity show with Tony and Jessica? Philip, if you are here, do you mind popping that in the chat? The link to that. You can also Google In the Money, Fidelity, OptionsPlay, and that will come up as well. I don't know why I made little tappy noises for that. But nonetheless, that is how. Okay. And we talked about that. We talked about that. So ideally, the max profit is when the stock stays exactly at the sell call strike price. Exactly. Yes, that is. But the reason why you structure a broken wing butterfly, as in this is allowing for 35 points of movement. This is mitigating risk at 20, is in case it goes too far. You're still putting yourself in a scenario where you'll make a gain. Thank you, Ratan, for putting that in there. Because that can happen. But your ideal scenario would be Nvidia to stay at 245. However, like it does, if it rallies too high, you're still in a profitable situation. Whereas if you made this equal, you would not be. And so that's the purpose of the broken wing butterfly. Instead of focusing on the time component, especially with a high beta, high volatile stock, you focus on risk versus reward. Awesome. Okay. So I think we answered all of those. See if there's anything else on here. I don't have a date for the technical analysis webinar. I apologize. Maybe I'll do some on my TikTok. The absent a binary event like trading, what is the ideal days to expiration for broken wing butterfly and balanced butterfly? Literally, the same rules apply. I would just do it a couple weeks before because I expect an increase in implied volatility. That's all. So the same rules apply at like a long call, debit spread, and then adding that together. That at the binary event just means don't hold it beyond that period, but literally the same. But I think that's a great question, and thank you for considering that. All right. Okay, and In the Money show is free to attend. You could just utilize that link. Work on trending stocks and breakout stocks? Yes. If you are speculative, expecting a sharp directional move, the way that it's structured, yes, it does. Okay, so I think we answered most of those questions. Excuse me, we got to about 5. There's a difference between call and put. Yes, the difference is just direction. So I had those slides. I didn't go through them. We can go through them really quickly if you'd like. It is the same thing. It's just instead of up, we're looking down. Literally identical. So purchasing the 170, I'd pay 5. I have substantial gain potential as it moves below my strike price. And then for the bear put spread, my strategy driver is still the long put, but I cap my gain potential by selecting a lower strike price. So the 160, but I also reduce my cost. So the gimme and the gotcha. So it's really just the direction. It works exactly the same. It's just the long call butterfly is bullish and the long put butterfly is bearish. And then same applies of putting together a bear put spread and a bull put spread will equal your long put butterfly, but it is bearish instead of bullish. That's it. Same exact concept. Quickest way to go through that. All right. We are talking about In the Money today, but that is at 2 p.m. Eastern time. And then they're posted normally the next day. It's live streamed on our YouTube and also on In the Money. Okay. So thank you everyone for attending today's session. This is the moment where I'll stay here for 90 seconds where you could say what you guys want to talk about next week. Let me know what topic you're looking for aside from technical analysis, because I know everyone is wanting that one. Lots of thank yous. Thanks. Any other trading strategies? Iron condors. We can do iron condors. 0 DTE. I usually leave that one to Tony, but maybe. All right, 0 TTE. I'm going to think about 0 DTE and talking about that. But definitely can do iron condors, straddles, and strangles if you would like. Enrolling, that's good. Current market. Okay. And other structure. Ratio spreads would be a good one. All right. Well, thank you so much for attending today's session, and I will see you guys next week.